think everyone's on mute, but that's okay. Okay, so it's 1906. It's time to get started. Thank you for joining. I hope I'll see people if they come along to join a little bit later, but let's get us started anyway. So this is the first extra session related to the fintech industry. This will look at the what we call the front office, the financial markets, and the activities that are conducted on in them, investment, trading, as opposed to looking at the financial market operations, which will be the topic of the second session. So let's just start us off with an overview of what we're going to do. So this will either be 2 or 3 sessions. The second one is definitely scheduled for the second 2 weeks from now, and that will look at the financial markets operations as we call the plumbing of the business. And for people that are interested in SaaS related or financial operations and are getting really into the technology, that might be of interest to you. Whereas today it will be a more overview of industry structure, how the industry operates, and opportunities from for startups in approaching financial institutions for business growth. Now, what I want to say is the structure for tonight. I've put 8 small sections together. Some of them are just a few slides, some of them are a little bit longer. And what I propose is that if you have a question, because I would like this to be interactive, not just myself speaking. If you have a question, put it into the chat, and as we get to the end of the section, which are brief, I'll review the questions that are in the chat, and I will also open the floor if there's any other questions. And then when that's done, we'll go over to the next section. And hopefully that means we can address any questions that come up in a timely way. So you can see the 8 sessions here. That's the order we'll go through. Some are very short, just a couple of slides. Some are a little bit longer. Okay, let's just start with a whirlwind overview of what the financial industry is all about. And in most of these sections tonight, and you get a copy of the video, you get a few references. So for those of you who have an interest to dig a little bit deeper into one of these topic sessions, because I'm going through it at a very high level, then these references are intended to give you some extra reading and a little bit more depth. But I'm not going to be reviewing these articles, some of which are quite long, in the session tonight. Okay, let's start at the heart of it. Money and government issues money, or at least it has historically. We'll look at some changes when we get to the end and talk to cryptocurrencies. But as background, money is a financial contract. And it's important, particularly when we get to the crypto world, to realize that historically, as money has been something that has always been issued by a government. They've backed it, they've controlled it, they've regulated, they've issued it. And as a government activity that's very important to the economy, it's an industry that's very highly regulated. I think that with the exception of the healthcare industry, the financial industry is probably the second most regulated industry in all of the world. And that's because it has such a major impact on all economic activity, all players from individuals to companies to governments. It's just that important. One thing we should be aware of is what is the major government entity that we read about in the news each day, and that is a central bank. And I want to give a brief overview and also dispel some myths about what central banks are. Central banks are, in most countries, a part of the government. They are set up as a quasi-independent agency to manage the money supply, and often have other roles, such as managing the banking system or things like that. But they're government entities. They are not independent from the government, but starting in the 1990s, many governments gave their central banks operational independence. So governments would give them the mandate, maybe an inflation target, maybe a growth target, or some other factors, and they gave the central bank operational independence to achieve those goals. So the central bankers could decide what policies they wanted to follow to try to achieve those goals. But at the end of the day, it's meeting the government's objectives, and mostly related to the money supply, and the regulation that goes around it. So the financial industry, it's everywhere. It's probably the biggest single industry in the world outside of government, I guess. And every person, business, activity uses financial services. Therefore, it's core to all aspects of society. So, for the purpose of these sessions, you could be approaching the financial industry from three different perspectives. You could be a fintech firm operating in the financial industry, and you want to know all the nuances of it, the regulations, so that you can be most successful. You might be a business that's not a financial entity, but you're serving that industry. And as we'll see later, because of all of the aspects of financial industry, we have a lot of service industries, SaaS industries serving the financial industry. So they can also be a very big customer for companies that are not in themselves financial firms. And then, of course, as an individual or maybe as a startup, you use banking services to go through your everyday activities. And as a small business, you will be very soon, if you're on the program, looking at setting up bank accounts, seeing what financial services you will need to have in the near term. So it's again second only to healthcare in terms of regulation, and maybe in terms of its prominence as an industry, the biggest, most important industry we have in the global economy. One thing to highlight, and this will become more evident when we get into the section about technology, is financial industry is all about intangible assets. There's no physical assets being manufactured. This is about securities contracts, now mostly in digital form, and data. And therefore, as a consequence, the financial industry is quite possibly the largest user of technology. And we'll look a little bit later the different stages the financial industry has gone through, and how they've been driven by changes in technology. And there's a really big correlation between a technological advance and a change in the financial market structure. And I'm sure there will always be. So that is the brief overview that I've put. So if there are any questions, feel free to put them into the chat box, or if you want to ask a question at any particular time. You see I've put this little break in to give us a pause to think at the end of each section if any questions come up. So just let me know. Otherwise, we will continue on if there's no questions so far. So let's look a bit at industry structure, because it's a big industry, but we can segment it into a few different segments that allow us to focus and understand the differences in parts of the industry, and how you may want to target one part of the industry if you're looking at it selling to the industry. And I'm going to use a model that originated from Canada, that's called the Four Pillars of Industry Structure. And there's the reference publications. But I think this is a very neat conceptual overview to look at what are, in effect, four industry subsectors to the financial industries: banks or commercial banks, investment dealers or investment banks, investment companies, or sometimes we call them asset management companies, and then the insurance sector. These to me are the four main subsectors of the financial industry. And so we'll take a moment to look at each one of them because they have some similarities. And in today's market, a lot of financial institutions are integrated, or financial services that provide some or all of these different things. But it's good to understand them from a conceptual point of view, the different activities, because they have different aspects about how they go and do business, what the risks and regulations are. So when we talk about the first pillar, commercial banks, we're thinking of the traditional bank that takes in deposits either from an individual or a company and then lends the money out as loans. What's important here, and we'll differentiate that to the investment bank that we're talking later, is a bank is a principal. So it is a separate contract in taking money in as a deposit and making a loan to a different party. So if you're a depositor to a financial institution, let's take a simplistic example where there's one deposit and one loan, and you deposit to a bank, and that bank then lends that amount of money to another company. If that company is unable to pay the bank back, that does not relieve the bank of its obligation to repay your deposit, because the bank is a principal on both transactions. It's legally required to honor both. This is very important, and this is the very important role that banks face or provide in society. When you think about all of the people out there, a lot of people, probably the vast majority, don't have financial or investment training. They're not in a position to make an assessment about whether the bank they're putting money into is safe or whether they would be better to use another bank. So it's policy around the world to try to make banks safe up to a certain limit so that the general public can deposit with confidence. And the first aspect to that is making sure that the bank is legally contracted on each deposit. It's not like you're buying a bond from the bank and you've got to analyze the company that issued the bond. No, you're dealing with that bank. That bank is responsible for dealing. That's important for consumer trust and for the public to use banks, because banks play a very pivotal role in aggregating money and using it for economic purposes. We'll see there's other ways that governments use to make banks safe, but this is a very important role that they play in our society, both to individuals and in terms of the economy. Now, something that has come up in the last 20 years is a growth in the sector that's called shadow banking. Um, I suppose I'm guessing everyone has heard of these terms. Does anyone know exactly what a shadow bank is? Do they want to sort of take a guess? I mean, I'm giving the answer away, but I want to make a point that goes back to this trust by the consumers. A shadow bank is an institution that is allowed to carry on banking activities, but is not regulated as a bank, and therefore, as we'll see a little bit later, will not have deposit insurance. That means if an individual of the public puts their money in this non-regulated bank that doesn't have deposit insurance, they are facing a much greater risk, because if the bank goes bankrupt, There is no government to come along to pay the depositors back some or all of their money. Now, we've seen over recent times where shadow banking sectors have grown very large. Um, I've been in China for the last 12 years, and from the period up to about 2014, there was an explosion. It was what was called peer-to-peer, P2P financial institutions. And these were shadow banks. And these were initially very popular because they were making high rates of interest on their loans and paying higher rates on their deposits. But a lot of them got into financial difficulty when the economy struggled. Some of them went bankrupt. And as they weren't regulated banks, depositors lost their money. So it's very important. Um, if you separate from the business aspect, if you know of someone, a family member or something, there's such an explosion of new banks these days, neobanks, fintechs, and everything like this. And one of the important things that I think is being diluted today is consumer confidence to know that the bank they're putting money in has deposit insurance. So one person in the office here, we were just talking yesterday, had invested in a new neobank in Hong Kong. Um, and so I asked her, I said, is it covered by deposit insurance? And she didn't know. So we looked through the regulations, we looked at the HKMA environment, and we saw that this bank, along with seven others, had been approved by the Hong Kong authorities and was fully covered by deposit insurance. So to an amount that was well above what she had deposited. So that gave her assurance because it was a regulated bank and it had deposit insurance, even though it was a new type of bank. So this is something you want to check with the proliferation of new types of financial institutions today. If you have friends or family that are depositing their money, you might want to check on their behalf. Are they backed in some way by deposit insurance? Because a lot of the new financial institutions may not be. So then we come to the second pillar, investment dealers, investment banks. These are the firms we know that underwrite and sell financial securities. Morgan Stanley, and of course, a lot of banks are both commercial banks and investment banks these days, Goldman Sachs and all of these types of firms. Now, what's important to differentiate this investment bank from a commercial bank is an investment dealer is not a principal in a long-term sense of an investment that you make through them. So let's give one example. You're an individual, maybe you're a high net worth individual. You want to buy some equities. You don't just want to put your money in a deposit. So you go to an investment dealer and they recommend a variety of shares for you to buy and you purchase from them. And maybe you purchase some bonds as well. This is not like putting money into a commercial bank where the bank that sells you the securities is obligated to repay you back if there's a problem. Here, you are totally dependent on return of your investment and any sort of income from the securities that you've bought. The investment dealer that sold you those securities has no liability to compensate you if there is a loss in part or in whole. That's why in many markets, because there's more investment risk in this sort of relation, we sometimes restrict the public's ability to buy higher risk securities from investment banks, because now we're seeing that the individual making the investment, as opposed to the depositor, has to do more research and due diligence to assess the risk of what they're investing into. And often the people in the general public won't be able to do that. So there's a fundamental difference between investment risk, a deposit in a bank, or buying an equity or a bond from an investment dealer. But both are big and important parts of the market. Just as a side, since we've introduced the concept of security, and this will be more the focus of the the second topic as opposed to on financial market operations. I'm just going to differentiate exchanges versus OTC, which stands for over-the-counter markets. It's not really a counter. There's no counter like there's a counter in the bar where two people lean over from two sides. It means direct selling between two parties, between two individuals, between two companies, without sort of an intermediary exchange in the middle regulating or settling those transactions. And this is very important because for the founders on the course, when you look to raise money for the first time, you're going to be looking for venture capital, which is a form of private equity. This is not going to be exchange driven. You're not going to have a listing. You're going to be in the private markets. And the only way your investor can exit from that if there is some sort of liquidity event or if they can sell their shares directly to another counterparty. So you will be dealing with this concept of private markets, direct selling, not exchange, by getting involved in your first round of private equity or venture capital funding. And that's sort of prefaced what is on this slide here. Um, One thing to highlight is that our focus is on Hong Kong and ASEAN. And we see here that, yes, there are exchanges in Hong Kong and Singapore, and there are, in theory, exchanges in some of the other countries. But the financial markets are not as developed, which means that the regulated exchange markets, which are traditional for equity, are not as big a part of the economy here. And therefore, the economies of the ASEAN nations to grow will probably, relative to Europe, America, or more developed markets, depend more on private capital markets. And so this is a personal area. This is an area of personal interest to me, the development of private markets. And we'll return to that a little bit later. I'm going to raise this issue here and define it in two ways, because this will be an interesting thing to compare to when we talk about our um, um, cryptocurrencies in the second last session of this thing here. And here's the story. Two events. Up until about 1981, most of the global activity for financial intermediation in debts was done by banking markets. Domestic bond markets were big in the United States, but globally, banking activity was the main source of financial intermediation in debt markets. But then we had a crash in 1981 of less developed countries that had a major impact on the global banking industry, such that it almost became insolvent. Now, banks were frequently protected by their governments to stop them from all going out of business, but they had no capacity to really grow and start new business. And so what we saw in the 1982 was when the market returned, debt financing was no longer being done by banks. It was being done by securities, by bond markets. And so that event, that financial crisis of 1981, created a fundamental change in the financial market, moving us from a banking-based or dominated market to a more securities-based dominated market. And that's still the case today. Securitization also has some other meanings which we'll revisit, but it is something to keep in the back of the mind, because when we talk about movements from traditional currencies to cryptocurrencies, we can see some similarities in some of the transitions that have happened before, like from banks into bond markets, government money into private sector money. So I'm just trying to lay some groundwork for what we will cover a little bit later on. There is a thought that and this is sort of academic theory, that as an economy grows in maturity and sophistication, it goes down a certain pathway. In the old days, when markets were very undeveloped and people had to deal directly with each other in a barter economy, that was very inefficient. And then that was the whole reason why banks became very popular, particularly, say, in Italy in the 1400s, as we moved from a barter to a banking market. Financial intermediaries came in. And then we looked at, as we just said in 1982, how globally things changed from banking based to security based. And this seems to be a progression that most markets go through, but in different ways and at different times and at different periods of time. If you are a service provider to the financial industry, this is something worth looking at because this may help you identify where there are opportunities for you to grow. So before, when I was talking about ASEAN, I said that financial markets, relatively speaking to other parts of the world, are not as well developed. So as we see economic development really picking up in countries like Vietnam, Malaysia, Thailand, and others, and if financial development is lagging, then relatively speaking, as a financial participant, there may be more opportunities for you in sort of this market where financial markets are less developed than in markets like America or Europe that are extremely competitive. So it's something to think about in terms of your business strategy if you're thinking of financial markets to directly participate in or looking to sell to financial services. Investment companies, investment management companies, asset management companies, companies that pool lots of people's or lots of companies' money together and to make investments on their behalf. They could be huge public funds that are investing the money of pension funds in billions and billions of dollars. They could be very small venture capital funds that maybe just have 5 million US dollars and look to invest no more than $25,000 in a particular startup. So they come in all sizes, all sorts of different focus in terms of industry, stage of development, but they're specialized in taking people's money and professionally investing for them. So when you, as a founder, and there are some out there, are looking to raise that capital for the first time, you'll be looking at maybe family offices, you'll be looking at angel investors, or maybe you will be looking at a venture capital fund, one of the funds that we're referring to in this session here. I'm going to skip over that slide and talk about the fourth pillar. And this, we're just laying the foundation for the industry structure. Insurance companies, which have typically been, of the four pillars, the one that was perceived to be most different, and the last one that was integrated into the other subsectors or allowed to be integrated by deregulation. Insurance generally falls into two subcategories itself. Life insurance, which is huge because there's so many people in the world, even with those who have the money to buy life insurance policies. It's a very big industry. Property and casualty is everything other than life insurance, protecting your home from burning down, planes from crashing, all sorts of other events. But it's a little bit different. And I wanted to highlight a difference we talk about in finance, which is the definition of financial risk versus insurance risk. When we talk about financial risk, when we're talking about investing, we're talking about what do we expect to return in the future? What sort of rate of return? What can we sell our securities for in the future? There's uncertainty, there's financial risk. If I buy something for 100 now and intend to sell it in 1 year, will I be able to sell it at 110 and make a 10% return? Or will I be forced to sell it at 90 and make a 10% loss? This is financial risk, price risk, return risk. When we talk about insurance risk, we're talking really about what is the probability of an adverse event and therefore being insured against that adverse event. And it's that differentiation, and we'll see a little bit later when we take the definition of an option just in one slide. Insurance risk and financial risk are really more similar than I'm portraying them on this graph here. But they've historically been looked at very separately, and the definitions are different. And this may be one of the reasons regulators have been most hesitant of allowing the insurance sector to be integrated with the other pillars. And I'll come back to this. Now, there's a couple of comments in here. Okay, they're general comments, not questions, so I won't stop for them right at the moment. This is what I wanted to do just as a prelude to something that we're going to cover in a couple of sessions. I've told you why insurance is different from sort of financial investing. Now I'm going to tell you why it really isn't different. And this is the concept of option theory. So option is like an insurance premium. You pay somebody some money to protect you against some future event. We talked about say fire insurance. You buy insurance on your home. If your house burns down, your insurance company reimburses you for the cost to rebuild the house. And so there's an example here. And we said that was different from sort of financial risk. But is it really? So, for example, if you were that person that invested 100 in the previous example, and you couldn't afford to suffer a loss of 10, you couldn't afford to sell for 90. Maybe the biggest loss you could afford is maybe one or two to sell for 98. So maybe you want to buy the security because you hope you'll get a gain, but maybe you want to buy insurance or an option to make sure that if you lose money, it never goes below a value that you can afford. So, for example, in this case, you could buy an option to put the bond to a counterparty at 98 so that you would never suffer a loss for that. So actually, we can see that there is, even though they look different on the surface, there's a very great similarity between insurance, which is really just selling options on adverse events, as opposed to adverse financial events. And just to conclude this second session on the four pillars, the financial industry is huge. And therefore, there are so many other activities that are not purely financial in themselves that support the industry, as you would expect in a large industry with lots of data and lots of customers. If you're a life insurance company, you probably have a department full of actuaries trying to assess mortality risk and how you should provide your premiums. Big companies need accountants, need auditors. People who have money will need investment consultants to help them invest properly if they just choose to invest directly as opposed to handing their money over to an investment management company. And the one I haven't put in here deliberately, because we'll look at it later, is technology. Because intangibles, all of the things being equal, lend themselves to technology as a user, as an advancer of the industry, and therefore the financial industry has been a prime user of technology, and changes in technology have been major drivers of changes in the industry. So that is the first two sections, which is a whirlwind overview, just to give us some background before we get into a few more specifics. Do we have any questions at this point in time? Anything you'd like to ask as a general overview that I haven't covered? Yes, no, thinking about it? Let's take a very quick poll and put a yes or no in the chat box. Do any of you invest your own money in financial institutions that are unregulated and not covered by deposit insurance? Do any of you invest in what we call shadow banks, basically? So some people, yes, some people, no. So for the people that answered yes, why did you choose that? Did you feel that you were able to assess the financial risk of the institution yourself, or was there some other reason for choosing that financial institution that didn't provide deposit insurance for your investment? I think,
Let me
Jeffrey, you
unmute my,
fell into that.
yes. Microfinance. I invested in a microfinance company that's doing microfinance, which is not basically backed by insurance, and it's more because I want to give back to people who have it less profitable than I have. So it's if there is a loss there, I would not be very sad.
Okay, okay. I think there is some sort of analogy to what we said in between a commercial bank and an investment bank. And we said in an investment bank, you're buying securities. You're not putting a deposit in a bank that's got deposit insurance. And we said that people who invest in other securities, regulations probably require them to have a certain amount of financial knowledge, training, or certificate to prove that they have enough sophistication to take those risks for themselves. But then Jeffrey has given us another side of that coin. If you have money to invest because you want to support some other activity as opposed to just putting the money in the bank to cover your weekly expenses, then some of the things you want to do, you won't be able to do through a traditional financial institution, like a bank that has deposit insurance. I doubt you could find any sort of big bank that you could put money in and try to dedicate to support a very specific type of activity because your contract as a depositor is independent with what the bank does in that money, who it lends it to, who invests it to. So Jeffrey just added a second component of why you may not go into a traditional bank. It's because you want your money to be directed in a certain way, a certain cause, and you can't do that in general through big banks that are taking in very large deposits. So that's a good example that just sort of was outside of some of the thoughts I thought about. Any other comments or questions at this time? I'm cognizant that I've been talking a lot, but we'll get into a little bit more into the way of particular examples. So if any question pops up along the way or something that you wanted to ask in the past, just put it in the chat box and we'll look at it in the next break time. Okay, customer segments. Um, This I put in last year because we had half a dozen fintechs on the course, which we didn't have this year. Um, and so this was a way to think about how you might target specific customers or prioritize who you wanted to target. But there will be at the end, I think also a lesson for founders in terms of using financial institutions. But let me go through this first component for someone who's either a fintech and targeting customers or a company that wants to sell to the financial industry. So, how do you target that? So, we've talked about the four pillars. So, as a first level, probably at the highest level, you may want to think about, do I want to target banks? Do I want to target insurance companies? Do I want to target asset managers or investment banks, or maybe more, or maybe all? And you will have to look at what was the original motivation for your product or service. Where do you find the best product fit? Where can you get traction? And that may be sort of one grouping that you will analyze, see what might be the first segment of the financial industry that you may want to target. A second segment um, may be geography. Remember, I said at the beginning that after the healthcare sector, the financial industry is probably the most regulated industry in the world. Industry regulation is largely on a jurisdictional basis, on a country by country basis, the EU being one exception, although they've not fully harmonized their laws. And therefore, if you operate in two different jurisdictions, say Hong Kong and Thailand, probably you will be facing quite different regulations or somewhat different regulations in those different jurisdictions, which will maybe require your service or offering to be different in the two jurisdictions. So, therefore, if you're a startup company, if you're in the financial services, whether you're the actual financial institution yourself or selling to a financial institution, because you'll have to adhere to their regulatory restrictions, then going into different geographic segments, different political jurisdictions may be a complexity because the regulation may be very different. And it may be much more challenging in one country than it is in another. And so, if given the choice between two countries about which one you want to approach first, then maybe looking at the regulation and seeing which one has a slightly easier regulatory environment to adapt to, that might be one of the decision criteria you use in creating your initial target market. And then customer segment. What do we mean by that? Well, it means who is the customer of that particular vertical or pillar in that particular trade. And so we typically break it down into three categories. Are we talking about individuals, consumer banking, retail banking? Are we talking about businesses? And typically we mean small to medium-sized businesses, because very large companies, other institutions like banks and governments tend to be put into a third category of institutional businesses. So there is, if you're a financial institution or if you're providing services to a financial institution, there's just a few elements that you may want to consider about trying to identify your target market. But let's turn this around and look at it from the other side, because I know in this year's Founder Institute cohort, we only have one fintech. So is there another way we can look at this slide? So you're a founder, um, and you want to go to market in the next couple of months. And what do you need to do before you commercialize? Well, you need to set up a company. You need to sign a contract with Founders Institute. Um, but you probably need to have some basic banking services. So you're a small business, and therefore you want to know not only what banking services do you want, but which institution should you deal with? If you're a small business, do you really want to deal with some huge global bank where you're one of 640,000 of their commercial customers, and the only way you can contact them is through a chat box and you never get any personal attention? Or do you want to maybe go with a much smaller bank that has more customized, more personalized service? So this customer segment um, can also be turned around to say, as one of those customer segments, small businesses, startup company in this way, which sort of financial institution do I want to deal with? Which one do I want to start my business with? If I'm starting in one jurisdiction, do I really need to deal with a large bank? I'm not going to have business in other countries. I may not be making international transfers. So we can look here and create a decision criteria for the founders who are coming out of this year's program to think, what is the financial services that they need? And as a result, what sort of financial institution do they want to go with and partner with for the first time? A classic example, even though it didn't end well, was in America and California, was Silicon Valley Bank. Now, unfortunately, they had bad asset liability management, and the bank had to be wound up and taken over by the government. But why did so many startup companies go with Silicon Valley Bank? Well, it's because the bank made it their priority to target that segment and create products or services that were really useful for startup companies that other banks didn't bother with. So when you're searching for a banking relationship for the first time, you need to look at these same components here, particularly your geography, the size, and decide what type of bank do you want to deal with, because that will be a very important component in your initial administration and success. So this is not all about banks looking at all other types of companies. We can turn it around and say, as a user of financial services, what financial institution do I want to deal with? What does it look like in terms of size, services it offers, and all those other things? Um, and very different opportunities lie in different regions. If you're like the business I'm in, where we're focusing on Southeast Asia, financial institutions outside of Hong Kong and Singapore, and maybe in Bangkok, are not as developed. And therefore, maybe you will have to look at a slightly different type of bank. Maybe you will look at one that is a shadow bank, because there is a lack of suitable alternatives for you. You have to be flexible when you go into an area where financial services are less developed, and you have to be aware of those differences. There's we'll come back to it when we're talking about technology, and we'll see how technology drives changes. But there's two other points I want to just touch upon here that I think are interesting in the financial services and for the customers of financial services. Regulatory changes can have huge impacts on industries. And I remember reading about a big UK insurance company in the spring of 2016. This was before the Brexit referendum was carried out. And at the shareholder meeting, I guess for the year ended 2015, probably was held in March or April, one person stood up at the shareholders meeting, because you're allowed to ask questions, and said, what do you anticipate the impact of Brexit, if it's approved, will be on your business? And one of the members of the management committee started talking about it, and in very diplomatic languages, clearly gave the impression that it would potentially hurt their business because they had a lot of business in Europe. It would make for more regulatory hurdles, and was speaking for about 5 minutes, and then all of a sudden, another person in the audience stood up, obviously a Brexit supporter, and said, "We don't want to hear you talk about politics. We came here to hear you talk about your business and your company. So stop talking about Brexit," and sat down. Well, I think that's a very important example to illustrate, because if you followed it, you know that Brexit has had profound and mostly negative effects on the British economy and the companies that are in there. Now, I don't want to get into a Brexit begging session. I could go on for hours that, but what I want to do is highlight that regulatory changes of a material nature can greatly impact the outlook for your company, not just in a negative way, in a positive way. And we'll look at a regulatory change in a few slides from now that was very positive for the financial industry. But unlike that person in the audience who said, don't talk about politics, politics, government policy, which becomes regulatory policy, can have huge and profound impacts on an industry and on a company in either a positive way or a negative way. So by no means ignore them. The other related point, um, vested interests. In the founder course, we talk about identifying a problem and then finding a good solution to solve that problem. One thing we touch on, but we probably don't emphasize it as much, and maybe we should in the following weeks, is um, all through the last 10 years, there's been a lot of discussion about disruption, new entrants into the market, disrupting old models, these companies going on, things like the Ubers, the Airbnbs, and things like that. And so disruption was viewed by some naively as, if you can disrupt an industry, that's great. But and that may be true, but there is one other element to consider, and that is, in every industry that you're entering, there are incumbent companies in there, and they don't want their industry to be disrupted because that may disrupt their business or make it less profitable. And so they may be very resistant to change. And let me give you just another example of that, because I think it's an important point to highlight when people are still trying to get their MVP and figuring out how to approach the market. We had one client who came up with what I thought was a really unique way to improve the e-commerce security and sales um, market. It did two things. It greatly reduced online fraud, but over and above that, because most people stop at that first point, it greatly reduced false positives in e-commerce. A false positive is when your online purchase gets declined, even though it's legitimate, valid purpose. So there's no fraud of money, but the merchant loses a sale because it doesn't get completed. And this new technology addressed both of those head on. And we just thought, and they just thought it was a great idea. And so when we were talking to them about approaching the market, we thought you can either approach merchants or you can approach some of the big card companies. So we decided to approach one of the big card companies, not the biggest, because, number two always tries harder. Um, and to go to them to say that, if you sort of embed this technology in your card, that will make your card really superior to your other big competitor cards out there, both in terms of the card holder that's buying something and it's not going to be defrauded, and also the merchant who's not going to lose sales because of false positives. And they sort of hummed and hawed, but they were completely uninterested in it. And we just couldn't figure this out. We'd done all the numbers, and so it was puzzling. Anyways, um, a couple of months later, we had a drink or eight with a person who had left that card company and explained us something, explained us about the fraud at the card company, and said, the companies have troves of data. They have lots of analysts. They know exactly what their expected loss is. So maybe in a market, credit card losses are 1.5% of sales. Well, in those same markets where they know they're going to lose on average 1.5%, for those types of transaction, cardholder not present, they charge the merchant 3%. And they can only charge them 3% because there's this risks involved that are not overcome. And so actually it's hugely profitable because they were charging commissions that were twice the rate of their expected loss. So they didn't want to shake that market up, reduce the frauds, because then they couldn't justify their 3% commission. They'd have to go down to 1%, which would still be profitable, but not nearly as profitable as before. And we didn't think about this. This was a couple of years back. And so what it taught me is that when you analyze something objectively from sort of a distance, it may seem very logical and your service or offering may just sound absolutely perfect. But unless you understand the incumbent players and what motivates them, and as outside, and unless someone gave you that inside information, you wouldn't know what their actual losses are and what they were charging, and that the current loss environment was actually very profitable for them. And that just negated the whole approach to card companies. And so we switched to merchants who were glad to take the reduction in lost sales because that was more revenue from them. And so we approached it. But it just goes to show that there's sometimes powerful interests that resist disruption because it's disrupting their own business. And sometimes um, their their resistance is based on things that are not visible to the outside world and that you really need to dig deep to understand them. So I make that account for that. So how are we doing? Any more questions? The chat box is not really filling up, so I don't know if that means I'm just doing a great job or I put everyone to sleep. So anything else out here? Anyone approach the financial industry with what they thought was a great idea, couldn't get it to fly and couldn't figure out the reason why? Has anyone had an experience like we had with the card companies a couple of years ago?
John, I have a question in the chat box.
Yeah. Let me see. Where is the chat box? Because I'm not getting an arrow up there. Oh, now it's just appeared. How would you categorize those businesses in finance industry pillars? Payment system, collateralized lender, DeFi, crypto. Let me see. Is that? And then there's one from Victor. Okay. So when we were talking about the four pillars, we were talking about industry subsectors. This question is talking in the first 2 points about specific industry activities. So, for example, whether you're a commercial bank, whether you're an investment bank, whether you're an insurance company, or whether you're an asset manager, you'll be using payment systems of some type to get money from your clients, to give money. So that payment systems are common to all aspects of the financial system. So that is a financial activity. That's not a financial sector. Now, it's confusing these days because some of the fintechs that are starting up are sort of single purpose activities, like a payment provider. And so they become uh, a company in and of itself, but they're only providing a single financial activity. So that's not a sector, that's an activity that's carried on payments by financial companies in all of those different actors. A collateralized lender. This, again, is more a particular product. So, as an investment banker, you may package together 100 bonds into a special purpose vehicle, and you may sell that special purpose vehicle as a new security, an asset-backed security backed by bonds, a collateralized security to investors. A collateralized lender, as opposed to a security, is a bank that is taking security for its loan. So it lends money to company A. It wants some sort of secondary source of repayment. So maybe it takes a legal charge over your real estate or a guarantee by the owner. So collateralization means providing some sort of security, financial security to the either the loan or the security, the bond security that's being sold. Decentralized crypto lender. Now, I'm going to leave that and come back to that a little bit later, because I'm guessing that is like a repo, and repo markets are big parts of security markets. And as I hope we'll conclude in the second last session when we go through crypto very quickly, there are very strong parallels between the securities markets, the aspects of how it works, and the crypto market. In fact, I will allege that at a very high level, a crypto is really just another type of private security. And therefore, all of the aspects of the securities markets, the payments, the settlements, the reconciliation, the safe custody, all of these things that we've been teaching for 30 or 40 years in securities markets conceptually apply to crypto markets. And of course, one big part of securities market is securities lending and borrowing, where we allow people to borrow securities so that they can short them or do other things. I've never been actively trading in the crypto market myself, so I'm speculating a little bit on this point. But if you're a crypto lender, if I'm interpreting that correctly as someone who's lending crypto as opposed to selling it in the same way we lend securities as opposed to sell it, then that's exactly what we do in the repo market for securities. Does that address the question?
Yes, thank you.
And then we've got many large pharmaceutical companies have investment companies as subsidiaries. So do large research organizations who invest in many biotechnology companies. What are the specifics of these sectors of investment companies? I think there's a lot of parts to your questions. What I would say with the first part, many large pharmaceutical companies have investment companies. Many large corporations, because they're so complex, may set up a separate financial treasury or maybe even their own bank. So it's sort of almost like outsourcing in a way, but they're keeping probably ownership control because they have such large needs for financial services. They set up their own bank or shadow bank, which is a financial subsidiary. So a lot of companies set up financial subsidiaries to be sort of their specialized treasury unit. Now, that's to provide treasury functions, payment mechanisms, foreign exchange, all of these. Some companies, if you're talking about investment companies, set up their own investment companies. These subsidiaries can be set up for different purposes. A large company may set up an investment company to manage the company's pension plan for its employees. So there's a lot of examples of that in Europe and America. Some companies that are dependent upon R&D for new things to go into the pipeline, like pharmaceutical companies, for example, they may do they may acquire a lot of companies that they think are successful and mix into their business. It's sort of like buying R&D. So instead of doing all of these researches from scratch and therefore suffering the losses of the ones that don't go anywhere and having to write off, you go out and you sort of cherry pick the ones at a stage you're comfortable taking them on and invest in them. And, maybe it's, they've proven themselves so far and they've just got to go through one last clinical trial before they can go to market. Every company will have their own criteria as opposed to what stage they will enter. But very large companies set up financial institutions for usually those two reasons, either to provide treasury or general financial payment treasury services to the corporation, or investment companies. And if they're an investment company, it's either for the pension plan or to invest in companies to give them new R&D along the pipeline. So I hope that answers that question. Okay.
Hello, John. I raised a question. So I want to know, is it possible, for example, for someone who have a lot of experience in a specific sector, is it possible to enter into such a sectoral financial services sector? Can you understand me?
What background are you giving to this hypothetical person? Financial background or the background in the science?
The background of a special sector, for example, pharmaceutical sector, healthcare sector. So, for example, a startup company, is it possible for them to enter into such specific sector services? I mean, the financial services for pharmaceutical companies, financial services for maybe for car manufacturer companies, etc. Sorry.
I mean, there's two decisions for every company to take. Do they want to do something in-house or do they want to outsource? That's one of the many criteria that companies have to make when following their business path. Some companies are more inclined to outsource activities. And if they do that, if you're talking specifically about investment companies, then like a company that's starting out as a founder, you need two skill sets. You need the industry subject knowledge, maybe the science, the technology, whatever it is, and then you need the business and financial management. And it's only when you have those two different companies into one do you have a hope to be successful. So if something is going to be an investment company, to find good investments, then you always need the two components, the subject matter expertise and the business expertise. Those two have to go together for any business to be successful.
Okay, thank you.
Okay. So anything else in the chat? No. Okay, so let me go back. Okay. Financial industry is heavily regulated. It's also, as we'll see, post 1982, become one of the global industries. Not every bank is global, but financial sector is pretty big. So let's look at what has driven this. And this is, I think, some interesting history, because if we understand what drove the changes in the past, then maybe that will help us understand what changes are happening now and what the likely outcomes of those are going to be. So I'm going to just mention very briefly three things that happened that completely changed the landscape of the financial markets over the last 60 years. The first one happened in the early 1960s, when the Western nations, their economies became much more prosperous, and people demanded more of a social welfare protection. They wanted better pensions. They wanted unemployment insurance. They wanted public health care. And to a greater or lesser extent, these social welfare programs grew in many of the states. One of the financial outcomes of this, because a big part of it was the development of pension plans, we suddenly had very large investment management companies, because, if the workforce is, say, 15 million people in the UK, if 15 million people are making contributions into a pension plan every month for many years, then after a period of time, that pension fund is going to be very, very large. Now, some government pension funds are pay as you go, but the corporate ones are not. So this move to pension funds in the early 60s as part of the social welfare state created large pools of money, which led to the institutional investors, the investment management companies or asset management companies that we have today. And that's very important because, fund managers, venture capital funds, these are big sources of capital to help new industries grow. Then in the 1980s, because politics always swings from one pendulum side to the other, we had a backlash against this, what some people called too much growth of the social welfare state. And we had a change in political outcome in the UK with the election of Margaret Thatcher and Ronald Reagan in the United States, who suddenly decided they wanted to cut the social welfare state back because taxes were too high. Government was involved in running too many businesses. I mean, it's quite extraordinary when you think about America now, that, prior to the 1980s, the governments owned airports, owned, post offices. There was so much government ownership by companies by the end of 1970s, that the new move, the shift to the right to privatize, really came into force. And one of the things that happened in this move to privatization was a massive deregulation of the financial industry, which, at least for the participants in the financial industry, led to incredible innovation, growth, and profitability. Some people outside of the financial industry don't necessarily argue it was always good for them, but for the financial industry participants, it was very significant, and it gave us a very high level of growth, profitability, and innovation in the financial industry. The third was the integration of financial products with insurance products. And this integration only came with the advancement of technology. So some of the big changes that happened in the financial industry were changes in regulation, which is why you've got to keep monitoring that. Some of them were driven by changes in technology, which is what we're going to look at next. So institutionalization of savings, this was the first point. Large pension funds in particular, large endowment funds of universities, these big, huge pools of money provided all sorts of risk capital that you don't typically get from banks that are doing more traditional lower risk lending. And so that created a much more entrepreneurial environment, more equity funding, eventually more private equity funding for startups. So the changes in regulation brought changes in the financial industry, which brought changes in the economy, the innovation, and started lots of new trends. The financial deregulation. UK's Big Bang, but it happened in other countries, not only allowed for a massive growth in new financial product and new initiatives, but it also helped integrate the financial industry around the globe. So this was, some would say correlation, but this was one of the contributors to globalization. And while traditional finance focuses on the transfer of capital, an equally important topic is the transfer of risk. And it was only when we got to this level, when the technology changed so much and we could properly assess risk, and we got bigger and bigger pools of data, which would seem tiny by today's standard, could we start integrating and creating new products and bringing the four pillars into one category. Now, I want to talk about one other thing, which, although it may be a financial story, it may be an interesting thing for founders who've got a good idea, but are trying to look for product market fit. And I'll tell the story of bankers' trust and credit default swaps, but then we'll generalize it to see how you can take sort of the message away from this to maybe find a new product market fit for an idea that you have. So here's the story. Bankers Trust, very innovative bank, now part of Deutsche Bank, but they were always at the leading edge of developing new financial products, interest rate swaps, securitization, and credit default swaps, which is the story I want to talk about here. Credit default swaps, CDS is the abbreviation, came about after the banking crash of 1982, where banks were sitting on huge bad loans. They didn't have any money to make new loans. They were really in trouble. And someone said, well, in the future, to stop this from happening, wouldn't it be great if we could have an insurance market for loans so that a bank could manage their risk, and if they had problem loans, it wouldn't take the bank down. Now, the problem was at that point in time that regulation kept the insurance industry totally separate from the other three pillars. So banks were not allowed to get involved in insurance, either as selling agents or as principal in managing their own books. But there was a huge screaming market need because there was no other way to manage your credit risk in terms of the market. So Bankers Trust came up with this idea. It was called a credit default swap. So Bank A has a loan of 100 and the borrower can't repay. It's almost a complete write-off. So how could Bank A have gotten some way to get out of that problem? Well, what it would be this. Bank A, long when it took the loan out before it went bad, would enter into a contract with Bank B that says that if a credit event happened, then Bank A, who made the loan, could sell the loan at its face value, 100% to Bank B, who then would repay Bank A in full, and Bank A would not suffer any loss. Now, Bank A is not technically, and obviously they had probably a whole firm of lawyers working on this, not buying insurance because they're not being reimbursed for a loss. When the event happened, they just sold the loan to someone else at its face value. There was no loss, there was no insurance claim or things like that. It was just a swap of a bad loan for its par value. And they didn't call it insurance, they called it a credit default swap. And so the lawyers managed to write credit default swaps in a legal contract that got around all of the fine print of all the regulation that prevented banks from being a party to insurance, even though we can all see, in essence, a CDS is just credit insurance. So when insurance isn't legally defined as insurance, that's how we say there's an arb to everything. And sometimes, because remember, financial markets are the second most regulated industry in the world, maybe you can find as your sort of killer app something that allows a big bank to get around a real headache in regulation, a really big problem to them that they can't solve. So maybe you can find an outsourced solution to go to a single bank and provide your solution as an offering for them. It's obviously hard to find arbitrage ways around regulation, but there are so many classic examples in history where smart people did exactly that. And so that's another potential way to find a business opportunity. Let's see, I've got something else in the chat here. Is really a good deal for big corporations to invest in green tech projects in foreign companies to get tax benefits to achieve ESG goals. As a startup in green tech, how can I approach these climate funds? I mean, there's multiple parts to your question, and some of them are value judgments, which I'm hesitant to do. Is it really a good deal for big corporations to invest in green tech projects in foreign countries to get tax benefits? On the surface, that's a value judgment, and I'm not going to do that. From a business perspective, if this is an interesting question, this is like we talked about in the session on Tuesday. The only way you get the real answer to that is talk to these companies and survey them. Because what I think is a good idea doesn't matter. If you want to attract these sorts of companies to invest in your business, to and maybe achieve ESG goals, then you have to go out and survey them. Because what I personally think about them means nothing. What is important to you as a business is finding out, is that important to them? And if it is, then potentially you have business to do with them. Your second or third part of the question is, as a startup in green tech, how can I approach these climate funds? They say the most difficult part of business development, and business development is a very general term about finding the right person to approach, then approaching, then making contact. The most difficult way is to find the right person to talk to. And that's a whole lesson in and of itself. There's very good search mechanisms that can help you identify who these climate funds are. So that should not be too difficult to find, at least. Then the question comes is, how do you find the right person to talk to, and how do you actually reach the person? And that is the challenging part. Are there people that that know people in these organizations that can provide you with an introduction? Do you cold call them? Which if you don't like cold calling, which a lot of people don't do, can be a very frustrating experience. But sometimes you have to do that. Sometimes you just have to contact 100 of these funds, hoping that 10 will reply to you and that you do business with one or two. That's the challenges of business development and sales, and why a lot of people don't like doing sales. So it's easy to search online and identify who, in theory, these green tech funds are. That's the easy part. The hard part then is, how do you make contact and start the dialogue with them? That's a session all in itself. So I'm going to defer on that just for the moment, because it's very, very difficult. I think that was the only one I had in the chat box. Is there anyone else to talk about? If not, we're almost getting there. So let's move on to the last few bits. This, I think, may be relevant to a lot of you, because many of you will be focused on technological advancements, and technology has really driven massive changes. So just to look at the different stages of the development of financial operations since the 1970s, we've gone from manual processing to straight through processing, which was the setup of digital processes and connectivity, but only inside the organization. There was no connectivity between different organizations. So straight through processing was digital integration, but only inside. And this took off in 1990, because that's when the personal computer really became commonplace and started getting some minimal adequate memory to do all of these processes, which couldn't do it just 10 years before that. And of course, fintech is when the internet became very mature, and all of a sudden then you could get connectivity between different organizations and within the whole market. So there was a dramatic change in 1980 to 2005, just that 25-year period, all driven by key changes in technology. The personal computer, or larger computing power, at the end of the 80s, and the advent or explosion of the internet towards the end of the 90s, that just transformed this market of financial things. So I'm getting a little bit behind, so I'm sort of summarizing these. So I'll skip over a couple of them because I've talked about them, but I want to focus on this slide, because I think this is relevant to people who have a SaaS product, and I think it gives a lot of hope. So at the end of the 1980s, there was about 5 or 6 large companies providing data services to the financial industry. And the financial industry is big consumers of data services. There was Bloomberg, there was Reuters, there was SIX, a big Swiss firm. There was one in Japan. There was one or two others in America. And they were all competing with a similar product offering. And then I think it was right around the very end of the 80s, maybe 1990, the Bloomberg terminal came out, and it had something on it called Bloomberg messaging, which really was just a public forerunner to email, but it was a private messaging service. And then all of a sudden, as an investment banker, you were connected with your fund management or central bank client. You could send private messages back and forth to them. Remember, the internet had not really taken off then. You could reconcile your trades with them. You could post prices and trades with them. It was something that no other of the competitors did that have. And it just propelled Bloomberg head and shoulders above all of the others. Bloomberg messaging was really a killer app that made all of the other five firms not really able to compete against them. And so this goes back to something I was talking to before about the ARB and bankers' trust. There's a lot of pain points still in the financial industry. There's a lot of big corporations that are missing a lot of things. And so as a fintech or a SaaS firm, if you can identify one of these other financial institutions' pain points and find a very good solution for them, then that can be a slightly different approach to a successful business. Because if you really can identify that problem and have that solution, then you've got a built-in buyer for your product, maybe even a company that will purchase your company in years to come. So looking at not just, as we say in the course, what is the big problem and how are you going to solve it? Just take a slight variation of that and say, what is the big problem financial institution A faces? And can I solve that for them? And if I can, then I've almost got a guaranteed customer. Just a variation on that approach to ideation. And I just wanted to talk about that after the Bloomberg messaging. And of course, there's lots of other things in the financial industry. There are so many legacy situations, systems. There's so many opportunities to make something newer and better. We'll focus more on them in the financial markets operations in 2 weeks. I'm not an expert on artificial intelligence, but I have a sense that artificial intelligence, because finance is so big and because it's an industry of intangibles, and because research is so important for it, it's going to have an even more profound impact on the financial industry than many others. Let me just give you one example why I think that's the case. Here is, apologize if it's too small, but you'll get a copy of these slides if you want it. This is the information memorandum for Tesla's IPO in 2010. So you can see it's about 200 pages long. There's about probably 20 different chapters. It references financial statements and other information that are probably even more than 200 pages long. So the one very important part of the financial industry is the investment side. And part of the investment process is doing research and doing due diligence. And for investment banks, have to produce these documents. Now, I do this for small firms. And so the investment memorandums I create are 40 and 45 pages, not thousands of pages long. But when you do that manually, it's a laborious process. It takes forever. It takes me about 1 month to do one properly and to have it all referenced. So if an investment bank can develop a really fine-tuned AI algorithm that can do an investment memorandum, maybe in minutes. Of course, it will have to be proofread and checked after. But if it can do 90% of the grunt work, then all of a sudden, as a corporate finance boutique or a big investment bank, your ability to underwrite new investments, the scale increases enormously. And if you're the first one to do that, then you've got huge competitive advantage against the other investment banks. So I'm speculating that AI in the research and the due diligence and document space is going to be a real hotspot for the financial industry in their use of AI, because it's something that's so big, it's so required by regulation, it's so time consuming, but it's all about information only. And so to me, that's sort of the perfect thing to create a killer app. And so this is an area that I'm following very, very closely. No more questions in the chat. I'm going to try to speed up. We've got 2 very short sections left, so we'll finish in 5 minutes. I know I'm running over. I wanted to talk about this because as founders on the course, you're going to be looking to raise money maybe within a year or something like this. And so before you go out, what you want to do is understand the market a little bit better, so that when you make your pitch that you've perfected on the course, you're knowledgeable about who you're talking to, the constraints, the industry that you're in. You can talk to them more knowledgeable, learn about a venture capital firm or an angel firm, about private capital markets. And then that will just make conversations with potential investors so much more easy and so much more interesting. I'm going to skip over that because what I want to do is close on 2 things, more statements given the time. And we're getting to crypto, and I'll admit I'm not an expert on crypto. But in doing the research I've been doing recently, I think there are so many strong parallels to the securities markets, and the processes that we put into the securities markets for trading, settling, payments, safe custody. I think all of these things, which considered sort of bread and butter knowledge in the securities industry, I think they can all be applied to the crypto market, which is still very fragmented, like the banking market was before 1982. But I think a lot of the lessons you can learn from seeing how the securities markets developed are likely applicable to this very early stage, or what I consider early stage of cryptocurrencies. I want to recount a recent experience. I was at the Greenwich Economic Forum just 2 weeks ago in Hong Kong. And before that, I was very cynical about cryptocurrencies because, what is the value proposition? And I was looking at Zuckerberg's first offering of Libra back in 2019. And, just what was the underlying motivation? And it was basically to make a private currency. So, a disruptor entering to a market. But who are the incumbents and how much influence they have and what sort of pushback are they going to have? Well, basically, he's challenging, because governments stand behind central banks which print money. He's challenging all of the central banks, all of the governments of the world. And to me, that was a pretty tall offer. And so that's why I was always initially very cynical about, what is the underlying value for crypto? What is acceptance? Because look at who you're trying to displace. But then I heard a very interesting counter argument by Manuel Blanco Appleby 2 weeks ago at the Greenwich Economic Forum. His firm, which is headquartered in Mexico City, only deals with Latin America. And as you know, the currency values in many of the Latin American countries is very volatile. There's been monstrous depreciations in Mexico, Brazil, Argentina. When the new president came in, even thought of getting rid of the currency altogether and going onto a dollar basis. And he mentioned how he's got a booming business in Latin America. And then all of a sudden I realized I was being rather myopic, in my view about cryptocurrencies and taking on the world, because I was only thinking in terms of the large developed economies. And of course, there's a big world of developing countries out there where the currencies have trouble maintaining their value, are very volatile, and maybe the governments can't even control a competitor coming in against their currencies. And so he's found a potentially large market for the cryptocurrencies through the Latin America. And so what that taught me as sort of a point is in finding product market fit, if you've got a great idea and you seem to have trouble selling it and getting someone to take it on, maybe you don't need to pivot in terms of the structure of the product. Maybe you just need to pivot in terms of the market you're focusing on. So maybe crypto is not something that's going to be a roaring success in the US, the Eurozone, or China, but maybe it is going to be a very big success in other parts of the world. So I learned something that day, and so I'm not quite as cynical as I was before the forum a couple of weeks back. And so I'm not going to go over this. This reflects the cynicism I previously had, which I'm now reevaluating. So that is the end of my 90-minute session in 118 minutes. Thank you for hanging out there. Are there any last questions I can take before you say goodnight? I don't see anything else in the chat right now. Does anyone want to put one or ask a question on the session? You'll all be getting recordings of this so you can see the links that I've put in. If there's one particular session you want to dive in a bit more detail, I put 2 or 3 links in. Some of them are in-depth articles just to give you a broad overview, because mine is just sort of a whirlwind tour of a lot of different topics today. But that's what the intention was, just to give a broad overview of what the major issues are.
John, I have
Anything?
question in chat.
Yep. Oh, you do? It's not showing up on my chat. Okay. I'm not getting a little bit. A lot of algo AI trading for Forex, crypto, and more. How those online brokers CO regulatory? What's CO regulatory?
Company, the brokers company.
A lot of algo AI trading for Forex, crypto, and more. How are these online brokers regulated? Okay, that's a very difficult question to answer generically, because regulation varies from jurisdiction to jurisdiction. The few generalizations I think that are safe to make is that these sorts of algorithmic tradings, whatever the underlying is, whether it's bonds, Forex, or cryptos, these are institutional investors. And so they are lightly regulated, and there's certainly no insurance on people who invest into these. These are sophisticated hedge funds, and almost certainly cannot use public money that is backstopped by deposit insurance. That I think I'm 99% certain that's the case everywhere. I don't think anyone provides insurance for money that goes into high frequency trading, hedge funds, or anything like this. So none of these are backstopped by deposit insurance schemes. I think I'm pretty safe to say that. How are they regulated? That will vary from jurisdiction to jurisdiction. So if you are a hedge fund in New York City doing high frequency trading, you will be regulated somewhat differently than if you're trying to do that in Singapore. If you're focusing on high frequency trading, that tends to happen only in a very small number of locations in very large cities with very big trading exchanges, usually exchanges. It has to be exchanges. You can't do OTC high frequency trading. That doesn't make sense. And so they're very limited in sites. I think the high frequency trading that was starting in Shanghai is being wound down, and now that they can no longer sell their funds through the banks with the recent change in regulation in China, that's probably going to disappear in China, and it will just stay in a couple of large cities like London, New York, and Chicago. But hedge fund trading, I mean, there's different levels of regulation. There's retail deposits that are covered by deposit insurance, and they're the most heavily regulated. Then there are other things like deposits over the deposit insurance limit, corporate deposits, and things like that that are regulated to a certain way. But when money goes into a hedge fund and they're restricted on who they can even take money, they can only take it from sophisticated investors or institutions, that money is completely at risk and very, very lightly regulated. I mean, the only regulation, I'm going out on a limb here, that these funds is things like know your client and anti-money laundering. But beyond that, they are, I don't think, regulated beyond that. Okay. So if that sorts everyone out, I'm going to stop the recording.